All right, we are live here. Okay, so now, although we don't do these kind of signals in this room, that doesn't mean we can't learn about them. And for those of you that are in both rooms, then this will obviously be a good discussion for you to talk about. Now, this is not going to result necessarily in a signal. This is going to be the analysis, and maybe something comes out of it, maybe it doesn't, because whatever I come up with, I'm obviously going to discuss with Scott before we do anything, because it's his room and not mine. Um, so let's just say that Scott and I have a very similar approach. It won't necessarily look the same way. Like I said, I tend to do a lot of spreadsheet type of stuff. He has all that stuff in his head. But very very rarely will we say, hey, take a look at STZ and let me know what you think. And he's wildly bearish and I'm wildly bullish. That very rarely happens, and if it does, it's usually a sign that we're probably both wrong. So, or it's probably something that we're missing, and it's probably perhaps not worth the risk. Okay, so ideally in an earnings type of situation, you'd like to make a non-delta play. Ideally, because if you don't have to pick a direction, why would you? Well, oftentimes the the type of delta plays that are neutral either are too expensive, or the risk to reward, which results in the risk to reward being too low. Now, that's not always. I mean, we definitely see iron condors that we put out. We definitely see strangle swaps that we put out. But oftentimes, those things might not play together nicely, and we have to do something directional. But the reward to risk on that is usually pretty darn good. Otherwise, we wouldn't do it. Okay, so we do have a constellation that is starting putting out before the open tomorrow, and just want to make sure my volume was in a good spot. Um, so what we first want to do is we want to look at, do we have a directional bias? Because we'll look at everything. We'll start from non-directional plays and work backwards. But we want to see, what has what do we have that we can look at? And really, the only thing that we can look at that's at all predictive, and it's not very predictive, is how does this thing act on earnings? If you've paid attention to earnings, there are just some stocks that outperform on earnings. Why? I don't know. Is it? I wish I could say, these are the ones that do it. But going back and looking at what this has done over the last 2 years gives you at least some idea. We can go here, and we can go back to January of 2017, and this is in Sterling Live Vol. They have a nice database in here. One of the big reasons that we like using it, it's also, I think, very user friendly for you guys to graphically see. I think that perhaps the information is in Thinkorswim, but it's not as easy to get to. I'm not, but at any rate, if there's any questions that come up, let me know. Okay, so we see that there's three main things that we're seeing here. They give us the first 5 days up to earnings, and then the next 6 days up to earnings. So we get an idea of what the underlying did, because that's really what we care about. I could care less if they beat EPS or they beat net revenue or whatever, because you can have both those things be positive, and yet the stock goes down. So what I'm concerned with, what did the stock do? Because that's the only thing that we're trading. We don't trade EPS. We don't trade revenue. Okay, this middle thing. This is where the the first two straddle markets were. So the front market straddle went from $4.38 to $14.48 in the time. Obviously, this is where it's going to be trading 14.48, and this is going to be where it's trading for $4.38. So you can see that for the short term and the longer term straddles. This is in volatility terms basically what happened here. Okay, and this is what we'll concentrate on, this and this, because not only, since we're doing implied volatility regression, right? This is what we this is what we're trying to play. The difference between shorter term and longer term volatility. We know that after earnings, let's get a year's worth of here. Here was earnings, right in here. What happens after earnings? Implied volatility comes down, and the difference between shorter term and longer term tend to regress. It's not an absolute certainty. It's not an absolute certainty, but let's just call it, as far as trading goes, it's a certainty. Okay, so we see that the general trend is implied volatility goes up, shorter term goes up faster than the longer term, and then they come down and they regress back. Okay, so implied volatility is actually pretty high here. Not as high, not off of its highs, but that's when the market was tanking. But we have this here. So going back here, so the first thing that we want to look at is, what did we do? What happened here? Okay, so here we went down. So we're 0 and 1, we're 1 and 1, we're 2 and 1, we're 3 and 1. So 2017 was pretty good, 3 and 1. Then we're 3 and 2, 4 and 2, 4 and 3, 5 and 3. So a little bit better to the upside than the downside. Not, it's not 7 out of 8, it's 5 out of 8. Gives you a little, if anything, if that's the only thing you can go on, you can say I'm thinking, I'm not thinking bearish. There's nothing, at least from this part of the analysis, that's telling me anything bearish. You can look at the regular price. This is a daily price chart. You can take a look at that and look for anything that's sticking out here. Now remember, technical levels mean nothing into and shortly after earnings. If they come out with earnings and they say, hey, listen, I know we projected that we were going to make $9 billion. We lost $9 billion. They don't care where support is. They don't, or if they say, hey, we just tripled revenue. They don't care where the 200-day moving average is. It's going because it's moving on fundamental stuff. Here, what you can say is, well, it was pretty darn bearish when the market was bearish. It put in a floor, couldn't go lower, and now it's starting to move up. So if anything, you could say, well, this is neutral to bullish. All right? And like I said, we're just looking for a bias. And then the last thing you can look for, since we do have the VP platform, we can look to see, and I don't have hard data on the efficacy of how this moves because of earnings. I've anecdotally been told by them that it's about 2/3 to 70% of the time. Like I said, I don't have any hard data on this, but this is showing the same sort of thing that we're seeing in the price chart. It was in a bearish channel, evened out, and actually today we got a bullish crossover. So all three of those, if I have to make one trade directionally, or I'm thinking the upside because I don't have any evidence that's saying downside other than I'm just going to guess, which I'm not in the business of guessing. So we have that. So if anything, we're looking neutral to bullish. Hopefully neutral. You never know. Okay. So now we've kind of taken our analysis part of it out. And now we can look at, okay, what are we going to do with options? First thing that you think about is, well, one, we have to calculate what's the scope of the move that we are looking at. And for that we need a couple pieces of information. Everybody knows. Price 172.24. When are we looking for? We're looking for just to the 11th because that's when most of the move is going to be. You can go out to next week actually, because we'll just do because there is going to be some in there. But that implied vol for the 18th is 52.1. So through January expiration, which is a week from Friday, they're expecting a, let's just say generically, 7.5 to an 8% move. If we only do to Friday, that vol is a lot higher. So basically there's a percent in the calendar from from a week from Friday to this Friday. So I would say that, pricing in a 8% move. What was that? Hang on, let's go. 7.5 to 8% move is probably where we're going to end up landing. 7.5 to 8%. Let's look at an 8% move, which is going to be to the upside. Is going to be, let's see, we're going to be looking at somewhere between probably around 86-ish. 86 is where we're looking at. Okay, well now we have to say, okay, well the first thing that I would want to look at is the strangle swap. So that's 86 to the upside, and I'm sorry, it would be 158 to the downside. So now we're not going to have exact strikes here. So we have the 57 halves, and we can do that. And we have the 185. We have either 185 or 187 half. Well, we already said we were a little bit bullish, so let's go out to the 87 halves. So that's going to be the short. So we're looking at the 157 half, 187 half. And then we're going to do the same strangle, but we're going to buy that next week. And we're going to do the same thing, except we're going to buy this. And 57 halves here. Okay, so without doing anything to implied vol, the market on this thing, it's a little bit wide. It's 40 bid at 125, putting, between 80 and 90 cents mid-market. The risk graph for this looks like this. We'll get this out here. And we'll look at this on, let's just push this out to the 11th. And this is what it's going to look like on the 11th. Look at that. You make money everywhere. But what did I just say? If we did nothing to implied volatility, what's going to happen to implied volatility? We talked about that when I brought up the graph. Let's get this to be. And technically, we don't make money everywhere. We're protected 18% up and 20%. 20% up and 18% down. But yeah, implied vol is going to drop, and front month vol is going to drop faster. Okay, so let's take this off, and now we have to say, okay, and here's where the art of it comes in. There is some math involved, but here's where the art of it. Where's implied volatility going to be? So the generic answer is they tend to take out about 30% of the implied vol of the longer dated option, and then you can model the front month or week in this case off of that. So going back to our database here, this earnings and div, and me bringing this into here. Okay, we know where implied vol went, and this is where implied, and we're going to be looking at this blue line because that is the second, or the longer dated option. So we know that implied volatility went from 22 to 17. That was way back then. Vol was a lot lower. Then it went from 27 to 20. Then it went from 23 to 16. Then it went from 24 to 19. And then, sorry. I messed that up. It went from 27 to 21. It went from 26 to 18. It went from 25 to 19. Then it went from 26 to 16. And then it went from 22 to 17, 27 to 20, 23 to 16. And then, we have more data than normal. 1, 2, 3. I think I must have doubled up on 10.5. 26 to 16. One, two, three, four. 1, 2, 3, 4. 1, 2, 3, 4, 5, 6. Well, that's why. because there's only 7 in here. So let's drop out the first one, since that's the furthest one away. And we went from 26 to 18. Then we went from 25 to 19. Then we went from 26 to 16. Then we went from 22 to 17. 27 to 20. 23 to 16. And then 24 to 19 last time. Okay, so you can see, so in general that rule of thumb held true. They take out about an average. Here they took out 27.5%. So like I said, the thumbnail, if you had to guess, it's about 30. They take out a little bit less than that. So if we're starting now with our at the money vol here on the 18th, at the money vol is 52.3. Let's go out to 52.3. Well, one thing for sure, and we saw that in the chart, vol's a heck of a lot higher now. Why? Because we're in a higher place. So if we're going to take the average of what they actually do take out, of what they did take out, excuse me. If we take out 27.59% of the vol out of this, that means that at the money vol here should be 30. Let's just say 38 at the money. Okay, we're going to still have a little bit of put skew in here. So we're going to take this just down to 40 because there's going to be skew in there still. And this is going to be just a little bit less. So I'm just going to take that down 1 vol from there. Now we go here and we use this to model what's going to happen in the front. Now I'm not going to take it all the way down to even though that tends to be what happens. I want to be conservative with my modeling. So I'm going to take this to like 45 and this to 42. 45 on the put side and 42. That actually might be a little bit too small. 50. I want to leave something in this. 50 and 55. That's probably pretty conservative. Okay, so now, obviously, this hasn't changed. Still 45 bid at 120 because that's the market. This is what our risk looks like now. So if we're looking at the 11th, we're getting rid of all this. So now we see it's still a pretty good place. I mean, we have to move a little bit. If we don't move at all, we're going to lose some money. If we do get, let's give ourselves here, we're covered theoretically up to about a 16% move, 15 to 16% move. They're only pricing in 8. We're pricing in 8. To the downside, we start making money, and then if we're down about 13%, we start to lose money. So not bad, so that might be something that you could consider. So I don't hate it. If we wanted to, if we said, you know what, this is kind of expensive and I don't like that, we can always take the put side out and just make this into a call calendar. And take out this put. Now this is going to look like this. Obviously, to the downside, we're going to lose our debit that we paid. Here's it on the 11th. So this thing doesn't cost much, right? Probably costs what, 40 cents? The market on this is 25 bid at 65. So that's 90, 45 mid-market. So if we go down, we're going to lose our 45 cents. If we go up, we can really hit it, and we don't lose money until up 17%, which is well within, we're going to have to get a double expected move for us to lose. So that would be, and so since the calendars look good, I would stick with that and not mess with iron condors or anything like that. So this is an approach. Like I said, there's The, this is not a signal. So, you know, I don't want anybody to say, hey, I did this and you messed up, Mike. Okay, this is something that I'm doing I wanted to show you guys an example because this is a lot of the thought process that goes through um, what Scott's approach is in the big room, the options vol room. Um, and, you know, I wanted to expose you guys to that because, you know, you can never get dumber learning, right? Okay. Rob, can I lay the iron condor on top of the calendar? You can lay, and you can put a straddle in there too if you want, but I would not make things that complicated. I mean, you're talking about then if you did a call calendar, you're talking about what, 6 legs in and out. I want to be your broker if you're going to do those sort of trades. Okay. All right. So I did record this. It's going to take a little bit of time for me to render it. I'm certainly going to talk to Scott and let him know what we see. There might be a signal for those of you that are out in Scott's room. I can't promise that, but that's that. Okay, everybody. All right, so that's it. Any questions? We'll see. And like I said, I'm not promising anything, but I will post this video. I'll post the video in both rooms. Okay, everybody, have a great. Well, I'm not leaving, but I'm going to go do some work.